Good morning, guys. So for this video, let's discuss chapter 8 of intermediate accounting. 1, receivable financing, pledge, assignment, and factoring. If we talk about receivable financing, it's a financial flexibility or capability of an entity to raise money out of its receivable. So basically, since a company does have a receivable from other company, they will do this receivable financing. They will sell these receivables at a discounted price. Just like, for example, they have a receivable of 1 million, so they will sell it to another entity, just like for example for 800,000, and that entity who received that receivable will be the one to receive the 1 million once the borrower will already pay. So during a general business decline, an entity may find itself in tight cash position because sales decrease and customers are not paying their accounts on time. So that's the very reason why we are doing receivable financing. But the entity's current accounts and notes payable must continue to be paid if its credit standing is not to suffer. So the entity then would be in a financial distress as collections of receivables are delayed, but cash payments for obligations must be maintained. Under the circumstances, if the situation becomes very critical, the entity may be forced to look for cash by financing its receivables. So there are 4 common forms of receivable financing. We have pledge, assignment, factoring, and discounting. So what is pledge? When loans are obtained from the bank or any lending institution, the accounts receivable may be pledged as collateral security for the payment of the loan. So normally the borrowing entity makes the collections of the pledge accounts but may be required to turn over the collection to the bank in satisfaction for the loan. So basically, they have obtained a loan from the bank and the receivable will be pledged as a collateral. So that's the purpose of pledge, to serve the receivable as a collateral, and well, they will still be the one to collect the receivable, but they will turn over it to the bank. No complex problem are involved in this form of financing except the accounting for the loan. The loan is recorded by debiting cash and discount on note payable if loan is discounted, and crediting note payable. The subsequent payment of the loan is recorded by debiting note payable and crediting cash. With respect to the pledge accounts, no entry would be necessary. It is sufficient that disclosure thereof is made in a note to financial statement. Okay, so on November 1 of 2020, just for us to be able to fully understand the concept, November 1, 2020, an entity borrowed 1 million from PNB and issued a promissory note for the same. The term of the loan is 1 year and discounted at 12%. The entity pledged accounts receivable of 2 million to secure the loan. So on November 1 of 2020, the journal entry to record the loan is, so we have a note payable bank of 1 million. So we are, as an accountant, we do have this, we do have this kind of entry because we are on the side of the borrower. We credited note payable bank 1 million. Then, since there is a discount, so let's compute the discount. Sorry, 1 million. So we got the the discount note payable by multiplying the carrying amount or the face value of the loan of 1 million multiplied by 12%. That's why we got 120, and the net proceeds is 880. That's why we got cash 880, and we debit as well discount note payable of 120. If the loan is discounted in the banking parlance, this means that the interest for the form of the loan is deducted in advance. So that's the concept. Again, if the loan is discounted, we will already deduct the interest from the term of the loan is deducted in advance. So on December 31, 2020, using the straight line method, the discount notes payable was amortized as interest expense. So whether it's a premium or a discount, we will always do the amortization. So we will debit interest expense 120 multiplied by 2 over 12 because November and December, and the discount on note payable, we will credit that one, so to reduce the 120. Okay, so because we already recognized we already amortized 2 months. At this point, your statement of financial position is prepared. So this is how we will present the note payable bank of 1 million and the discount on note payable of 100,000, because the 120 was reduced to 20,000 by 20,000. the interest expense that we recognized last December 31, 2020 for November and December. So that's why we got a carrying amount of 900,000. So there is a note that you need to put if you are in this kind of situation. So the note payable to bank matures on November 1 of 2021 and is secured by accounts receivable with the face value of 2 million. Again, it was mentioned that if you are going to pledge your accounts receivable, you have to, there is no entry at all to be made on the side of the entity who pledged the AR. It was mentioned that we will just put it in the notes in the notes to financial statement, I mean. So it's up to you how you will state the notes of financial statement, as long as it is understandable by the general public. So the note payable to bank matures on November 1, 2021 and is secured by accounts receivable with face value of 2 million. So November 1 of 2021, we're gonna be paying the entire sorry guys, in the entire note. That's why we debit note payable bank to reduce the payable and credit cash of 1 million. And also the discount will also be amortized. Finally, debit interest expense, credit discount on note payable of 100,000. So there's the accounting procedure for pledging of accounts receivable is not that complicated. So you just have to keep in mind all of those things. Okay, so let's proceed to the second concept, second form of receivable financing. We have the assignment of accounts receivable. Assignment of accounts receivable means that a borrower called the assigner transfer rights in some accounts receivable to a lender called the assignee in consideration for a loan. Actually, assignment is a more formal type of pledging of AR. Assignment is secured borrowing evidence by financing agreement and promissory note, both of which the assigner signs. Okay. However, pledging is general because all accounts receivable serve as collateral security of the loan. On the other hand, assignment is specific because specific AR serve as collateral security for the loan. So basically, that's the difference. If we talk about pledge, all accounts receivable, but if we talk about assignment, a specific AR will be used as a collateral. Assignment may be done either on a non-notification or notification basis. So, what is notification? Non-notification, I mean. When accounts are assigned on a non-notification basis, customers are not informed that their accounts have been assigned. So, they will not be informed. They will not be no communication will be made. As a result, customers continue to make payments to the original company, and who in turn, it will be the one to remit the collections to the assignee. Okay? So, just like the pledging, that's just like the pledging, that's for the non-notification. But if we talk about notification, they are notified, the customers are notified, and they are the one paying directly to the assignee. The assignee usually lends only a certain percentage of the face value of the accounts assigned because the assigned accounts may not be fully realized by reason of such factors. So that's why we do have this kind of percentage depending on the quality of accounts. The assignee usually charges interest for the loan that it makes and requires a service or financing charge for or commission for the assignment agreement. Okay, so let's have this illustration for us to understand the accounting for assignment of accounts receivable. So let's start with the non-notification basis. Okay, so for page 225, so let's discuss the accounting for non-notification basis. And an entity assigned on April 1, 700,000 of accounts receivable to a bank under a non-notification arrangement. The bank advanced 80% less a service charge of 5,000. So basically, the 80% of 700,000, that is 560. And it was mentioned that there is a service charge of 5,000. That's why we only got a cash of proceeds of 555,000. So the entity also signed a promissory that provides for interest of 1% per month on the unpaid loan balance. So the entry, accounts receivable assigned, that is 700,000. And we will recognize the AR. And just to do the formal entry. And to record the loan, we already computed the 555,000. That's the proceed of the loan and the service charge of 5,000. Then the note payable of the note payable from the bank is 560, which is the 80% of the 700,000. Okay? So, on April 5, issued a credit memo for sales return to a customer whose account was signed, 20,000. So, sales return, 20,000. And the AR assigned, because we already recognized the original AR in the previous entry. That's why the one to be credited, that the one to be recognized will be the AR assigned of 20,000. Then, collected 300,000 of the assigned account less 2% discount. So, again, the AR assigned will be reduced again of the amounting of 300,000, but the amount that we receive is only cash of 294,000, which in return we will remit it to the assignee. And the sales discount we will recognize as 2% of the 300,000. Then, we remitted the total collections to the bank plus interest for 1 month. To 294, it was mentioned that there is at 1%. So that's why 560,000 will be multiplied by 1% to get the interest per month. So we remitted 299,600. So see, we still have a loss for this one because we already received 294,000, but we have to pay a total of 299,600. Well, that's really the essence of doing the assignment. And on May 7, assigned a account of 15 proved worthless. So we will also recognize that again. So we will recognize allowance for doubtful accounts, and we will recognize the AR assigned of worth 15,000. Then collected 300 of the assigned accounts, so cash, and we will reduce again the assigned account of 300,000. Remitted the total amount, so again we will remit that one again. So the note sorry, remitted the total amount due to the bank to pay off the loan balance plus interest for 1 month. The interest for 1 month is 266,000. How did we get the 2,660,000? Okay, so the total accounts receivable assigned is 700. Then it was mentioned that there is already a collection of 294 and 300, so it will be deducted 594. Then also it was mentioned that there is a sales discount, so it will be considered sales return 20,000 and 15,000. So we already have 635, and there's still a balance of 65,000. So how did we get the note payable bank? So 560, the original carrying amount of the loan, so 560, and we deducted the 294 because that's what we received previously, and the difference is 266. Okay, and to record the interest expense, that's 266,000. In order to record the interest expense for the month, 1%, 266,000 multiplied by 1%, that's why we got 2,660. So the total cash that we remitted is 268,660. So basically, there is still a difference or a balance of 65,000. So we have to transfer the remaining balance of assigned accounts to accounts receivable. So it will be recognized again. It will be put at the AR account. So we have to put AR of 65,000. That's still a collection, and AR assigned will be credited to recognize that one from our book. So that is the accounting for the assignment of accounts receivable on a non-notification basis. All right. Sorry. So let's proceed to notification basis. Okay, on July 1, an entity assigned one, so that again the difference is the customer will be paying directly to the assignee or to the one who received the AR, and because they will be notified. An entity assigned 1 million of accounts receivable to a bank under a non-notification arrangement. The bank loans 80% less 4% service charge of the gross. So again, that's 800,000 times 0.96. So to reduce the the 4% surcharge is 1 million times 0.04, so we got 40,000. So 800,000 will be deducted or will be reduced by 40,000. That's why on the second entry, cash of 760, that the net proceed, and the service charge of 40,000. So still the note payable of the bank is 800,000. The first entry, we will they recognize the AR 1 million and accounts receivable assigned of 1 million debited. Received notice from the bank that 600,000 of the assigned accounts were collected, less 2% discount. So, a check was sent to the bank for the interest due. So, note payable bank, so it will be derecognized, 588. Why? Because we got a 2% discount. This is discount of 12,000. So, AR assigned on the side of the original owner of the AR, that's 600,000. We derecognize. And we still have to recognize the interest income, interest expense, which is 1% per month. So 800,000 the original, because we just received the first payment, so we got 800,000 times 1%, so 8,000. Okay, on August 31, sorry, we receive a notice from the bank that, sorry guys, I'll have to have a quick break. Okay, on August 31, we received a notice from the bank that the 300,000 of the assigned accounts were collected. So, we already received 600. It was mentioned, and we also received the 300,000. So, final settlement was made by the bank for the excess collection because we only the bank only accepted the 80%, which is 800,000, but the total collection on the side of the bank is already 900,000. So there is an excess collection of 100,000. So how to do that? So basically, previously, in the next page, we have the computation loan from bank of 800,000. Then we have the collection of 588 because 600 was discounted. So balance due to the bank is 212,000. However, we received 300, or the bank received 300. There is an excess collection of 88,000. So again, we still have to remit 1% interest expense based on the remaining balance of the loan. So 212,000 multiplied by 1%, that's why we got 2,120. So the excess collection of 88,000, the 88,000 will be reduced. So it will be reduced, guys. It was not in parenthesis, but it will be reduced. It will reduce, ha. Kay the excess collection, it will be given to us. But since we need to provide interest expense, interest expense of 1% of the remainder of the account, the loan account, that's why it was reduced 2,120. So the remittance from the bank is 85,880. That is our that is a cash on the side of the original owner of the AR. So statement presentation. So an entity provide the following accounts at year end. Okay. So basically, we have already assigned the 1 million. It was mentioned here. And unassigned is 4 million. So allowance for doubtful accounts, it's 100,000. A note payable bank related to assignment, that is 400,000. So we have here the net realizable value of 4.9 is included in the caption trade and other receivables. So how did we get that 4.9? So AR assigned, or unassigned, or AR assigned, that's 5 million. Then since we have already allowance for doubtful accounts, that's 100,000. This is additional information, guys. Don't be confused. So that realizable value of 4.9 million. So that is how we will present the trade and other receivables in the financial statement. Equity in assigned accounts. Moreover, the entity shall disclose its equity in the assigned accounts determined as follows. So we have AR assigned of 1 million and a note payable of 400,000. So equity in assigned accounts, because we have this additional information, 400,000. That's additional information. It's not the same on the transaction we discussed July 1 to August 31. So we just want the book just wanted to present equity in assigned accounts. So that's 1 million, then 400,000. So we got equity in assigned accounts, that's 600,000. Okay. So we'll already discuss the first two forms of receivable financing: pledge of accounts receivable and assignment of accounts receivable with to accounting. We have the non-notification basis and the notification basis. Okay, so I will cut this video. I will continue my discussion. If ever I would be able to prepare a video prior our discussion, so I will prepare. But since we'll be meeting by tomorrow, that would be April 15. So if I won't be able to prepare an additional video, so by tomorrow, as mentioned, we will be discussing the remaining points for chapter for this chapter. Okay, so thank you guys for watching.